First of all, I mean, we always say that we're data dependent, and the data have been really pretty good on the economy. We just, you heard David talk about that. We added 3 million jobs last year. Job growth still has been very strong coming into the first quarter of this year. GDP growth's been strong. All the signs of our, consumer spending is strong. So we have a strong economy. We want a strong economy. That's all very good news. But it also means that the rates that we have haven't caused the economy to slow too much. It seems like monetary policy is working the way I think we hoped it would. We're seeing imbalances in the economy come down. We're seeing the tightness of the labor market become less over time. We're seeing inflation come down, and we're seeing wage growth come down. So monetary policy is in a good place. I think we've got interest rates in a place that is moving us gradually to our goals. So I definitely don't feel urgency to cut interest rates. I think monetary policy is doing exactly what we'd like to see. Over time, the data will inform kind of our decisions. I think eventually, my expectation is as inflation gets all the way to 2% on a sustained basis, as the economy is in good balance, interest rates will need to be lower at some point. But the timing of that's driven by the economy. The economic data, like I said, are strong on the labor market and GDP and spending. And on inflation, it's a little bit of a bumpy road, but overall the trend is the inflation has gradually coming down.
Well, is there a possibility that the U.S. economy is so hot that the Fed would consider actually raising rates? Because we've seen the recent retail spending numbers were stronger than expected. You talked about the jobs market. The last jobs number was kind of a blowout compared to what the expectations were, and we're seeing inflation not tick down in the way that the Fed had hoped for. And consumers seem to be feeling better, actually, where consumer sentiment had been the lagging factor, but now that seems to be getting better as well. So is there a possibility the Fed could even raise rates?
Well, it's not my baseline. My expectation right now is that interest rates are in a good place, and eventually at some point would want to lower interest rates as the economy really gets to the 2% inflation that we're headed towards. Of course, you never know what can happen if if the data are telling us that we would need higher interest rates to achieve our goals. Then we would obviously want to do that. So it's not my base case, but one of the things we've learned over the past few years is it's hard to predict the future, and we need to adjust our policy stance as appropriate to achieve our goals. I think one thing that's really important in this is that when you hear 3% growth, and you hear 3 million jobs or 275,000 jobs a month that we've been seeing the first part of this year, it's in the context of a supply side of the economy that is really strong. We're seeing really strong labor force growth. We're seeing really good productivity growth. So these 3% numbers, I think, are driven in large part by strong supply and strong demand. That's why we can see these strong numbers, and at the same time, the unemployment rate is relatively flat at 3.8%, and we're seeing the imbalances in the labor market actually recede, not get tighter. So this is really more of a supply-driven, I would say, expansion right now. And for monetary policy, it's not, we just need to make sure that demand and supply are in balance.